If you're a first-time home buyer, you're probably asking yourself, should you wait for lower interest rates or will home prices continue to rise? In this episode, we're actually showing you how mortgage rates are shaping the market in 2025, and not just for monthly payments, but for home prices, competition, as well as your long-term wealth. And we're going to walk you through what smart buyers are doing right now to get ahead, no matter where rates go next. So, Josh, home prices, interest rates, what are we talking about here?
Everything comes back to for buyers of all stripes, but first time buyers especially, everything comes back to affordability. So we talk a ton about affordability. Three factors that impact it: wages, home prices, interest rates. Interest rates are the ones that can move in the most volatile fashion, up, down in a short time frame. Home prices generally don't. They move slowly in one direction or the other, although coming through COVID, we saw a sharp spike up. Wages definitely don't see these big spikes. Even during COVID, when we were seeing big year-over-year wage increases, it was 6-7%. It wasn't like a 15, 20, 30% increase. So when we talk about affordability, interest rates is the biggest thing that can move them in the short run. And kind of two pieces of it here, Jeb, that make it really important. If you're looking at buying, you obviously know, hey, at a 3% interest rate, I can afford either much, much more home, or I can afford the home I want with a much lower, more affordable payment. But the second piece of it is where interest rates dictate things. And we think at some point will be a positive for the market is in terms of the supply and demand dynamics. Demand is goosed by lower interest rates. Lower interest rates, higher affordability increases demand. And if you're a buyer, you're like, well, I don't want more demand. I want me to be the only demand and have a lot of supply so I can go in and name my price. Well, lower interest rates at some point should impact supply as well. For those of you who've listened for a long time, you know, folks like Jeb got to a situation where their family had grown, they needed a new home, and eventually they were willing to leave an ultra low interest rate for a higher interest rate. That was a pretty big gap for you, Jeb. It was like a 4% change in interest rate, more than double the interest rate when you did it. And now you've refinanced it down to only about double. But that's keeping a significant amount of supply out of the market. So we're seeing headlines that supply is improving, but that's really a regional story, really through the Gulf states, specifically Florida and some parts of Texas. If you're in the Northeast, you're like, hey, cool story, bro. There's no improvement in supply here for us. So today we're going to try to unpack where interest rates are, where they're going, but within the context of what this means for home prices going forward.
Yeah, we've done a number of episodes on mortgage rates, on tariffs, of just uncertainty in the market, right? There's a lot of what ifs, what happens, if this plays out this way or what have you. And all of that volatility is impacting mortgage rates. And it's not only impacting mortgage rates, it's impacting the psyche of the buyer, Josh, because it impacts the stock market. People have money in the stock market. People see the news, the headlines, all of these different things. And it's a mindset shift a little bit. And people are now a little bit more worried because they don't truly know what the future holds with not only mortgage rates, but house prices. And we're going to talk more about home prices because there's some changes there as well. But I think it's important to understand the three metrics that you talked about, but the bigger one of the three being how much mortgage rates truly impact not just demand, but that affordability component. It is true. I mean, that's why we saw all of that demand pulled forward during the pandemic, is because you had all of these buyers turning prime buying age, interest rates go to the lowest level that we've ever seen on record, and people just thought, well, God, it's so less expensive now to own a home. Why wouldn't I do this? So now you're kind of seeing the opposite side of it. So how does that actually play in, Josh, into what we're seeing and how it could affect home prices?
Well, think about it. It was sort of the reverse of what people expected. We saw through COVID, the second half of 2020, all of 2021, home prices were going up, but demand was just incredibly high because interest rates remained at ultra low levels, plus or minus 3%. So when we say 3% versus 6%, your average buyer in that $400,000 to $500,000 price point, they're looking at payments at least 50, 60% higher than they were at. So that just by necessity, it takes out a large portion of people who would like to buy. We have no limit of willing demand, people willing to buy homes. We definitely have a lack of able demand. And so interest rates act as a brake on that demand. And for a good portion of that, that's a positive right now, that demand is limited. People talk about home sales in the low 4 millions, lowest levels since the late 1990s. That's not positive for mortgage and real estate professionals like you and I. It's not positive for the health of the economy because it impacts things all the way through. When people buy homes, they buy home furnishings, they buy TVs, they go to Home Depot, they go to Lowe's, they do all sorts of things that trickle through the economy. So overall, that's not good. But the demand being lower is a positive in that if we still had really high demand, supply has not gone up because of a number of factors. Just literally not enough units in the U.S., but so many people at these ultra low interest rates that are locked in. So if we're looking at saying, what comes next? Where does this go? That's the $24 million question. And at the best of times, Jeb, the crystal ball is fairly hazy. In the current times with President Chaos in office, from one week to the next, they're sending out mixed messages. The message of the week right now, I mean, this is going to be 7 to 10 days before this publishes, but he's hammering on Powell. Interest rates are too high, and we're gonna replace Powell. And this just with so much uncertainty out there, markets don't like this. We saw rates go up yesterday, which again, it's going to be out of date by the time you're listening to this, but rates went up yesterday for no other reason than just the uncertainty. So it would be nice for us to get some certainty on the trade front because we're still 60 days out from the 90-day pause on these tariffs. It appears as though the tone is, hey, we're shifting towards this is really a China issue. We don't need to beat up on all of our friends around the world as much. But that uncertainty makes it difficult for us to forecast what happens next. If we look at the underlying fundamentals, you and I read one of my favorite reads every quarter. Lacey Hunt over at Hoisington Investment Management comes out with the most dense 4-page PDF that it takes about an hour and a half to read and understand. Thankfully, we have GPT to translate it for us nowadays. But going through it, he still believes that all of the underlying fundamentals are there for much lower interest rates. But we also have tariffs. Tariffs in the short run are inflationary. Uncertainty is deemed inflationary because businesses are not making decisions. I had my assistant came to me yesterday and said, hey, things were going really good, 30, 45 days ago. Is it really just all of the uncertainty and the chaos? Yeah, that's exactly what it is. Because you listening at home, many of you are saying, hey, I'm not sure what comes next. So in the big picture, I don't know your feelings, Jeb, but I feel like this is going to be a blip, but that blip has lasted much longer than expected because I just don't think that either the planning from the White House wasn't well thought out or they just truly did not foresee the reaction of the markets to this wide scale of a reset with all of our trading partners.
No, I mean, and on top of that, Zillow published that the typical U.S. mortgage payment now eats up 35% of median income, which is far above the 30% affordability threshold. And then it goes on to say first-time home buyers are now facing monthly payments that are $1,200 to $1,500 a month higher than just 3 years ago. So you can see how rates, don't just affect how much you can afford, but they reshape the entire market from, demand to inventory to ultimately house prices. So Josh, let's talk about the house price thing. Zillow's come out. They've changed their forecast. Now, Zillow is one of those that has basically a monthly forecast, an ongoing monthly forecast, whereas Josh and I typically come out once a year, maybe twice a year, and update the forecast, but they update it monthly. And so now they've turned a little bit bearish, right? The headlines out there is that Zillow's bearish, home prices are declining. They're expecting a 1.7% decline from March of this year to March of next year. And a lot of it's regional. So depending on where you're located in the country, you might have higher than 1.7%. In other countries, you have still positive growth, right?
If you're considering buying a home, you want to see what the numbers look like, if it makes sense for you today, we can help through about 20 different states that cover 85% of our audience, and we can get you connected with a pro in any state where you're located. So if you want to go through that rock solid pre-approval process, so we can look at where you're at, what your needs are, what you want to do, and get you a plan so that you know what you qualify for, what the monthly payment looks like, and how much cash you need, and all of your options, ensuring that you have optimal financing if you decide to buy. Reach out. We've got a link in the description below. You get you connected to my team and we'll get you taken care of.
And the best part, it's free.
Free.
I have some beliefs on home prices, but what are your thoughts, Josh?
Well, one of our favorite analysts, Lance Lambert over at Resi Club, they do a very good job of not taking one piece of data. So if you're just looking at your local newspaper, if you're looking even at Wall Street Journal, any of the major national news, they want clicks, because most of us don't pick up a newspaper anymore. You're looking at it online, and they want you to click on that. So stating this, hey, prices are going to drop, that gets clicks. So they're more likely to do that. What Lance does, it's a subscription service. You can't get it for free. You get a few of his articles for free, but they look at it from multiple different angles. Zillow is one that they look at regularly. He looks at it over time, and he went through and pointed out areas where he thought they were way too bearish. He thought that the Northeast was not going to be as strong as it is, and we're still seeing very constrained supply there. And everyone that we talk to in that area, the people that we're working with on the mortgage side that are looking in that area, it's a tough market. I had one that the appraisal came in $20,000 low last month, but there were 10 offers on the property. So it tells you that prices are going up fairly rapidly, and there's so much demand that our buyer was putting 35% down. It didn't matter. She was willing to let that appraisal go, but not all folks are in that situation. So what he was saying is, it was focused, Zillow is focused too much on areas that definitely are seeing increases in supply. And if interest rates remain elevated, I mean, realistically, at the best levels, we locked a few here earlier in the spring, well-qualified 30-year fixed conventional loans at like 6.499, a couple of FHAs under 6%. That's about as good as rates got. Are we a ton worse than that? Maybe as much as 0.5%, but 0.3%. But when, in light of those numbers that you just threw out there, Jeb, you have $1,200 higher payment, and then over the course of a few weeks, it's $150 more a month. Definitely limits some things. So I think it's important when you see the headlines, know what the data is. Zillow, I look at as more of like a nowcast. So we talk about the Cleveland Fed does their inflation nowcast. The Atlanta Fed does their GDP nowcast. And when you look at it at any given moment, it can be distorted by the most recent news. They're looking at this saying, hey, rates were 6.5. Everyone was hoping they were going to trend down to 6.25%, 6%, and keep that volume of sales increasing, keep improving affordability, and keep a floor of demand underneath the supply that is increasing in many parts of the country. But that is why they adjusted their number. And that's why we're talking about interest rates today, and interest rates specifically in the context of what it means for you in terms of a home price. So if I'm going to buy, am I going to have to pay more? If I'm buying, does it mean home prices are going to drop and I overpaid for my house? This is where it comes back to, and bringing it back to Lance at Resi Club, they monitor 800 different metros. So you need to be looking all the way down to your local metro. It's not enough to say, hey, the Northeast encompasses 6, 7, 8, 10 states. So each one of those states behaves differently. Within those states, other cities, other school districts, other zip codes are behaving differently. So it is important for you to know on a macro level, it's really, really hard for us to predict what happens with interest rates. I am biased. I'm biased probably by 40 years in this industry of seeing rates go nowhere but down. But with that, we watch the data, and I can hear very strong cases for why inflation and interest rates are going to remain higher. I think the preponderance of the evidence tells us that we're going to see a recession. We're going to see a slowing economy for all of the reasons we've talked about ad nauseum over the last 3-4 episodes, and that will bring interest rates lower. It doesn't take them back to 3%, probably doesn't take them back to 4%, but a 5.5, a 6, a 6.25, we've seen every time that happens. We see purchase applications increase. So there is pent up demand out there, willing demand, people that want to buy, they're just not able or truly willing to sign off on what it is. So know your area of what is happening with home prices where you want to buy, and then keep an eye on what happens with interest rates, because it's going to dictate whether we see less sales or more sales, and whether we see the high end of most areas, other than some of the hotter markets in the Northeast, is probably going to be 3-4% appreciation on the high end. And some areas are going to be flat. Some areas are going to be down. If you're not in the Gulf Coast states, you probably don't need to worry about that this year. But if you're there and you're wanting to buy, it's something you want to keep an eye on.
Yeah, I'm having more conversations with sellers than I've had for this time of year than I've had in the last couple of years. People interested in selling their homes. I'm also having conversations with a lot of people in the market just in general that are a little bit more worried. And I think it kind of goes back to what we talked about earlier, the uncertainty, the unknowns of just rates and everything impacting the economy. A lot of, headline news, a lot of, one-liners coming from our president, and just what does all of this mean? And so I think if we stay in the range that we're in right now, Josh, somewhere between that 6.5% and 7%, we continue to see what we've seen, which is somewhat of a slowing market, right? Home prices not really appreciating, homes sitting on the market longer, price cuts remaining a little bit elevated over previous years. And if rates move higher, Josh, from here, over 7, stays above 7, I think you see a more of a decline nationwide in home prices. It's still going to remain regional, but I do, see inventory growing. People just unwilling to stay in homes that no longer fits their needs. Some people, just wanting to get out and move to different areas. Whatever the reason is, there's a lot of those conversations happening. I mean, here in Orange County, where we are, we've seen the highest inventory right now that we've seen going back to 2022, and chances are it's going to continue to increase from here. So I can see a market that becomes a lot more buyer friendly as we progress through this year. I do believe, like you said, that we're going to see lower rates. The problem is, I don't know that we see the economy soften like you and I think it truly is softening for 6 months from now. I think the data, because it lags in many ways, even though we're going to have some GDP numbers coming out soon, that's probably going to show a decline in the first quarter or what have you. This stuff, it takes a little bit of while for it to trickle through the economy. And so by the time that happens, we're out of that prime buying season, Josh. And that doesn't mean people don't buy. It just means it's a little bit different market than earlier in the spring. And I don't think we're going to have, yes, demand's going to increase, but is it going to increase at the same level as it would right now if we had rates at 5.5%?
Well, I think what you said is really, really important. The timing of this, what do they call it? Liberation Day on April 2nd.
Yep.
Really right there in the prime of spring buying season, a couple weeks before tax day. A lot of people think of tax day as a bad thing, but
Yes,
many people look at it as $5,000, $6,000, $7,000, $8,000 refund because they over withhold throughout the year. And they go, hey, I'm not the greatest saver, but I'll let Uncle Sam keep my money. And now I have that coming in and I can use that for part of my down payment, part of my closing costs. So we really took the wind out of the sails of the market. Not that it was a super robust market, but it was trending better than the previous 2 years, 23 and 24. And we took the wind out of the sails right at the absolute worst time. And no matter what happens, nothing is going to come back. Like if we had the type of economy that led to a 5.5% interest rate, there will be a lot of people who are sort of not immune, but inoculated from that sort of downturn in the economy, and they would jump right in. But many people would be like, "Ooh, there's some stuff going on that is dropping interest rates this much. So as much as I want to jump in and take advantage, so there would be a lot of refinance activity for the people that bought in 23 and 24 and didn't get to take advantage last fall when rates fell." But it's not going to put the wind back in the sails of the market because there's reasons for that seasonality of the market. So we've missed the best part of the year. We're unlikely to get it back. And the thing that can put the wind back in the sails of the market, lower interest rates, is not going to have the same impact when it's coming at the wrong time of year and also as part of a downturn. So Logan did a podcast this morning where he was talking about recession and what it does to home prices. If you look, for the most part, home prices hold up pretty well through recession. But I don't love looking at the current market and going back and forecasting. If you look at the last 3 or 4 recessions that we've had, those weren't voluntary recessions. To a degree, they're talking about this being a voluntary recession, meaning self-inflicted. Like we were sort of humming along. Maybe it wasn't a robust economy, but it was a positive, not a negative growth economy. And here we're sitting here with things that we have chosen to implement that are hastening the downturn in the economy. So from that perspective, what you said is really important.
Well, yeah, and I read an article this morning that Redfin, they aggregate data from a lot of different markets, and they primarily look, I think, more at what's happening with their agents and stuff in some of the data that they post, but that the largest decline or largest number of buyers backing out of contracts recently because of all of the chaos in the market. And so what that does is that allows inventory to grow, right? And we always talk about supply and demand. Depending on where you are, more supply either helps the market or it hurts the market, depending on which side of the equation you're on. And if you're in one of those markets in the Southeast, those markets are problematic at the moment. There's more inventory. A lot of it is because of building and just migration patterns and what have you. And so just pay attention to what's happening locally in your market before making these decisions. But Josh, I just said something that I want to jump onto, and that's the building piece, right? We've seen a lot of new construction over the last couple of years. New construction often leads us, into recessions and out of recessions in some regard because of workers there. At the moment, it looks to be, on that front, slowing down. We still haven't, headed specifically into a recession with the number of layoffs and that sort of thing happening. But how does that piece factor into what we're going to see next and potentially down the road, Josh, with inventory and the lack thereof that could impact prices long into the future?
In terms of building, when the market is not robust, the builders, just like every business, are looking at these tariffs. The numbers that we've seen say like 9% of the goods that go into a home, the materials that go into a home are impacted by tariffs, and it will add about $10,000 on average to the price of a home. Well, we're talking about builders who are already constrained because they've been able to keep prices up by making larger concessions, meaning that magic ultra low interest rate and $30,000 towards your closing costs. It doesn't come out of nowhere. It comes out of their profits. So they subsidize their wholly owned subsidiary mortgage company to give you the deal of a lifetime on the mortgage, because a 6% concession, I believe the number is, it equates to about a 16% price cut. So would they rather give you 6% towards your concessions, or would they rather cut that home price 16%? It's pretty obvious. So there's also, Jeb, there on that flip side, a lesson for you as a buyer if you're buying an existing home. If you're looking at that and you are in a market where the seller is more amenable to concessions versus a home price, or if there's just a supply demand imbalance where there is more supply of homes and you can negotiate and you have some of that strength, you can do the same thing on an existing home where you can go and say, hey, I want 2 or 3%. On an FHA, you can ask for 6% concessions. I'm not saying that is the best thing to do or the wisest thing to do, but you can get that same amount of money and apply it to the same type of permanent buy down. Or if you really think the market is going to drop in the next couple of years, you can do a temporary buy down. But big picture, what you were talking about in terms of building, because builders' profits have been constrained, they're uncertain about what comes next. They have less permits. So we're looking at less new homes being built going forward because of the economics of building right now. So nothing big picture wise comes along and solves the lack of supply on a macro scale. We're not building enough homes. We haven't built enough homes for the last 10 or 15 years. And now we're not having enough permits to keep pace going forward.
So, Josh, I think that's important to note because permits, right? Builders pull permits doesn't necessarily mean they build a home right then. But if they're not pulling permits into the future, then that's a process that has to take place before they start building, which means there's a delay there. And part of the reason that we're in the situation that we're in now is because we had this quote unquote delay over the last 10 years previous to the pandemic, coming out of the Great Recession, where builders didn't build because of the unknowns, the uncertainty, the cost, all of those things. And then all of a sudden they start getting back into building. And guess what? Now we're 4 to 6 million homes, depending on who you read, behind based on population levels, based on buyer demand, all of these different factors. So if builders stop building now for whatever reason, they're not going to stop entirely, but they're going to slow down. That just means demand, inventory, supply issues into the future, which again, we're kicking that can, just punting it further and further down the road, where we're not truly solving the bigger issue here in the United States, which is we just don't have enough homes. And I know that's hard for people to believe, but the reality is we don't. And yes, immigration policies and that sort of thing will impact and allow that number to come down a little bit, assuming what actually is talked about takes place. But either way, you still have a lot of homes that are behind. And if we stop building, then, what does that mean for the future?
Well, if you look at it, going back 2008, 2007, those builders learned their lesson. We had a demographic dip. Gen Xers were hitting a point where the next coming years had less and less people coming of prime home buying age, right when the economy had the mother of all recessions, led by housing, and they built like crazy right through it. So the builders just got hammered. And they've said, we're going to keep a much better eye on this, a much tighter leash on it, and never get ourselves to a position where we've built way too many homes. So you can look at this good side. For a good side from the economy, you don't have a propensity for a housing market crash because of being overbuilt. But for you as a buyer, if it's underbuilt, it's artificially pushing prices higher. At the same time, that's new inventory of homes being built and put into the market. The existing is also not turning over at the rate that it otherwise would have. It was a great thing during the pandemic. The government said, hey, we can either give out money or we can buy it and it's used. So your stimulus check, what do we get, like $1,200 stimulus checks?
Yeah.
And most people, it's gone in a few weeks. Well, if a person has a $300,000 mortgage and they get to go from 4.5% to 3% for the next 30 years, that's a much more massive stimulus, and it doesn't really come out of the government's pocket.
What if you
other
get both?
than the cost. So we got both. We got all of it. We got the full fire hose. So the downside to that is that subsidy for those people in those homes now makes it very, very hard for them to move on willingly. So we're getting supply hits from all sides. So the affordability is a demand hit. So supply is limited. Demand is limited. So we don't have a recipe for a big run up in prices. We've talked about this before. I don't think we have a recipe for a big dip in prices. You tell me anywhere from -5 to +5 over the next year, and I'm going to tell you that tells me what happened with interest rates. You hit it earlier. If we have 7.5%, 8% interest rates, we could see a 3%, 4%, 5% dip nationally, worse in pockets and not as bad in other areas, but nationally. And if we were to see 4 or 5% appreciation this year, it's because the economy slowed and rates were in the fives later this year. So it's almost like you can look at what happens with home prices and not have to know what happened with interest rates, because the interest rates are going to be the driver of that, because it impacts affordability and what demand there is for the limited supply that we have.
Yeah. And before we move forward, do us a favor. If you find any value in this episode, do us a favor and hit that thumbs up. And if you want to stay updated on everything real estate and mortgage related, make sure you subscribe to the channel. So Josh, I think the question a lot of people out there are asking themselves at the moment is, what if I buy now and rates decline or house prices decline? What should I do? Should I buy or should I wait?
So we always give the same answer, but let's modify that answer to what we're looking at in the current market and what the buyers that we're talking to are kind of walking themselves through. Say, buy when it's the right time in your life. So you have solid finances, you've saved a down payment, you've worked your credit score up, you're comfortable in your career and that you have a job and that you're able to pay your bills, comfortable in your relationship, you're going to be somewhere for a period of time. We're either have kids or we're planning to have kids. We can grow into this house. We have a 5 to 7 year time horizon. If you can answer all of those and you can afford to qualify in the current market and it doesn't blow your budget, then by all means, go ahead and buy. But what are we seeing? I've had a couple of people in industries that are potentially impacted by the government cuts and were worried about losing their job. One of them already got clarity that she needed and they stepped in and bought and closed 2 weeks ago. Others are still sitting on the sidelines. So if you don't have that clarity on any of those fronts, but really what are we seeing right now? Is my job secure? Is my income secure? If you have that, and you're not in an area where you're seeing, major increases in supply, where you're at risk of decreases in home prices, there is no reason to delay, because the cool thing is buying a home with a 30-year fixed mortgage, that sets your worst level. we can get better and better again and better again. You can refinance as many times as you want to. A lot of times people say, well, it costs money every time. Well, depending on your loan size and the costs in your state, you can do a no-cost loan. This is, well, I got to start back over to 30-year. No, you don't. You can do a custom loan term and keep matching that or even shortening it to get you there in a shorter time frame. So the ability to strategically refinance as rates come down lower is always there for you. So if the time is right in your life and you feel the desire to buy a home, most parts of the country right now, I would have no issue with that. Some parts of the country, if you're in Southwest Florida and you want to buy a condo, I would be very, very careful about buying a condo unless I was getting a massive, massive discount where I felt I could withstand a little bit of a downturn. But what are your thoughts on that, Jeff?
No, I think it's good advice. I mean, I think the premise here is that you don't need a perfect market, right? You just need a strategy. And, buying right it's less about timing and more about just having the readiness, having things in place, doing the prep work up front so that you know that you're making the right decision for you. And you're not caught up in the chaos of headlines and the chaos of what the president's doing. At the end of the day, that once you're a homeowner, that has very little impact on what you do every single month when you make your payment, right? That's what you need to think about. And I think that's where you got to come from, right? It's all about preparation. It's all about having the foundation that we often talk about and it being the right time in your life. So with that said, I'm going to ask something a little bit different on today's episode. And that if you found any value in this at all, do us a favor, not only hit the thumbs up but share it. Share it with somebody that you believe could benefit from hearing the things that we talk about, because sharing helps the show grow and ultimately helps us impact and improve the educated home buyer out there that we're trying to create. So if you could do us a favor and do that, we'd be very, very grateful. But we post every single Monday, so make sure you tune in next week. Until then, buy right, borrow smart, build wealth. Adios.
Amigos.